Very good afternoon to all our viewers. On behalf of the Professional Development Committee, I would like to extend a very warm welcome to this webinar on NBFCs. So today we have our chairperson of the Professional Development Committee, CA Kamisha Soni ma'am. She is the chairperson of the Professional Development Committee and also the chairperson of Committee on Public and Government Financial Management. And ma'am has a lot of credits to her. She's a technical advisor of the International Ethics Standard Board for Accountants. She's also been nominated as a member on Committee on Government and Public Sector Enterprises. And ma'am has a lot of firsts to her credit. She's the first woman member, chairperson of the Indore branch, and also the first chairperson of CIRC, and also the first chairperson of the Board of Studies. So ma'am has a lot of firsts to her. And she has been a lot of proficiency in academic and also experience and professional expertise. And ma'am has been awarded with a lot of awards, like she's been given Pratibha Codes and lot of awards to her credit. And I'll request ma'am, please, if you could give a formal welcome to all our viewers, and also to B. Sivakumar sir, who is the CGM RBI, ma'am. Thank you, ma'am.
Thank you, Seema ji. A very good afternoon to one and all. As a chairperson of the Professional Development Committee of the ICI, I welcome all the viewers to the webinar on Statutory Audit of NBFC. We extend a very warm welcome to respected Shri B. Shivakumarji, Chief General Manager, Department of Supervision, Reserve Bank of India. Shri B. Shivakumarji has started his career in the RBI with the bank's banking department. He has experience in banking supervision, banking regulation, currency management, and monitoring policy. And it is a matter of great honor for us, sir, for agreeing to share your views on expectation of RBI from the statutory auditors of NBFC. I would also acknowledge the presence of, I think in absentia, CA Prasanna Kumardi, Vice Chairman, our Professional Development Committee. I would also like to welcome CA Vikas Kumar, who will speak on the topic Key Aspects in NBFC's Audit, CA Manish Sampatji, who will share his views on recent regulatory changes relating to NBFCs, and CA Sandeep ji, who will be presenting on very important area of NBFC audit, IT security risk in audit of NBFCs. As you all are aware, the Institute of Chartered Accountant of India is conscious of the importance which the RBI is laying down on NBFC sector. We note the significant progress made in this sector over the years. NBFC's ecosystem in our country is a place of immense diversity and is also very complex. There are more than 9,500 NBFCs across 12 different categories, focusing on a diverse set of product, customer segment, and geography. So over the last 5 years, the NBFC sector has grown significantly, and the demand and supply both are contributing to the growth of NBFCs. So, dear members, given the large quantum of the public money handled by NBFCs and geographical spread of the client base, RBI has prescribed a strict regulatory regime for their registration and functioning related to compliance to ensure proper functioning of NBFCs and protect the misuse of public fund by them. So the statutory audit of NBFC is also one of the important instruments to bring discipline and functioning of NBFCs. Our members undertaking audit of NBFCs have a huge responsibility, and the ICI is taking various measures to build the capacity of the members and to support our members in this area. Further, in order to create awareness amongst chartered accountants regarding various provision compliances pertaining to regulation of NBFCs, the Institute has taken various steps. With regard, first, I would like to just update about with regards to the implementation of Ind AS. So ICI, being the premier accounting body in India, has been engaged in formulation of Ind AS. Apart from formulation of Ind AS, the ICI has been taking various initiatives to get the member of the ICI and other stakeholders ready for implementation of Ind AS. So ICI has taken a number of steps to satisfactorily ensure smooth, trouble-free transition to Ind AS. And pursuant to the applicability of Ind AS for NBFC with net worth INR 500 crore or more from financial year 18-19 and all other listed NBFCs and unlisted NBFC with net worth of 250 CR and above from financial year 19-20 onward, various steps have been taken to facilitate the implementation of Ind AS for NBFC. Further, ICI has come up with the clarification from time to time on issues received while transitioning to Ind AS pertaining to roadmap, applicability of Ind AS on NBFC, as well as various implementation related matter pertaining to Ind AS received from companies, including NBFCs, on various Ind AS, including financial instrument standard relevant for financial sector, and to impart in-depth knowledge on vital topic relevant to NBFC, such as financial instrument standard, leases, and so on. Refresher courses on each of the said topics are being organized from time to time. So for 2 5-day refresher course and 1 10-day refresher course have been organized, and also webinar on Ind AS are also conducted from time to time. So ICI has been focusing on the banking sector. Likewise, the institute has set up a study group for preparing a guidance note on NBFC to lay equal importance on non-banking sector. So these guidance note would cover all the applicable laws, regulations, and would be updated from time to time. We will also incorporate certain divergence, non-compliance related to NBFC also, and even the major divergence cases along with their detail which have been observed by Reserve Bank of India during the inspection and has been shared with ICI for the guidance of auditor will also be included in this guidance note on NBFCs. Now, I would just update about at ICI level. Sir, we have expert advisory committee. This committee has been set up with a view to reply to the queries on accounting, auditing and allied matter received from members, and to publish and create awareness about the opinion issued by committee in answering queries received from NBFCs companies on accounting and auditing principle. So that also we have compiled. Whatever expert opinion has been given by our EAC, that we will incorporate in that publication. And also for reviewing the financial statement, we have Financial Reporting Review Board. It has been set up to review the general purpose financial statement to certain enterprises, and auditors report has suo motu taken up review of financial statement of NBFC along with banks. So the review report of FRRB also been shared with Reserve Bank of India. And in order to emphasize on the important notification and event and development of NBFC, ICI has designed an NBFC corner at homepage of our website, that is NBFC corner at ici.org, to create awareness about regulatory provision and updated regulatory provision and improve the compliances of NBFC among members at large. So that also we have created. And apart from ICI initiative, Department of Non-Banking Supervision, Reserve Bank of India normally holds state level coordination committee meeting, SLCC, once in every quarter to regulate non-banking financial companies and deposit accepted activities of incorporated bodies, UIBs, at each of their regional offices. So the institute, along with other regulators, is a member of SLCC and is regularly attending the meeting on pan-India basis. And we are also again compiling all issues which are specifically related to NBFC, and definitely in very short span of time we will release that publications 360-degree about NBFC related norms and provisions. So with these words, I once again welcome and recognize the presence of Shri B. Shivakumarji. Sir, we are really obliged for your valuable time and presence. And with these words, I once again welcome all the viewers for joining this webinar. All of you may ask questions on the window provided for the purpose, And I hope that you all will be benefited from the discussions of the webinar. So again, I will request our Professional Development Committee Director, Seema Garotra ji.
Thank you so much, ma'am. You very nicely explained us the initiatives which the various committees and departments have taken for this NBFC. And ma'am, about that publication also, which you have mentioned, we'll be very shortly coming out with this. Now, I'll like to welcome Shri B. Sivakumar, sir. So thank you so much for your presence, sir. I'll just give a brief introduction. B. Sivakumar, sir, he is the Chief General Manager of the Department of Supervision, Reserve Bank of India. Sir has a very extensive experience in banking supervision, banking regulation, currency management, and monetary policy. Sir's academic accomplishments, they range from, he's an MBA, he's also done CAIIB, he's also done MPP, GRIPS, Japan. Sir, the Institute of Chartered Accountants of India is very extremely honored and privileged to have your presence, sir, today. And our members would really benefit from your presence, sir. And sir would be addressing us on the expectations which the Reserve Bank of India has from the auditors of NBFC. And sir, we welcome you and we request you to please guide and our members on this topic, sir. Thank you, sir.
Thanks a lot for the kind words. Am I audible to all of you?
Yes, sir. Yes.
Yes, sir. Yes, sir.
I hope there is no echo problem and all. Okay. Once again, good afternoon. I thank the organizers for the opportunity. Before I start my presentation, I want to bring to your kind attention that over the past 1 year, there is a significant increase in the number and quality of interactions between RBI and ICAI, which is a very healthy trend. If you can kindly observe, right from the last week of December 2021, wherein our Deputy Governor, Shri M.K. Jain, addressed ICAI forum, I had also addressed a couple of forums, and we have also commenced with the structured periodical meetings with ICAI. First such meeting took place in the last week of June 2022. We have taken up several agenda items. The forum was hugely benefited by the discussion, and we are also planning to hold second such structured periodical meeting in tentatively in another about a month or so. With this brief introduction, let me start off with my presentation. I will share my screen with you. Can you make full screen? Can you make a full screen?
Full screen.
Okay. Okay. Can we take this thing out also?
Yes.
So that I hope you can see my screen.
Yes, sir. Perfect.
The topic given to me is RBI's perspective and vision on the expectations of RBI from the auditors of NBFCs. What I've done is the topic will be covered under 3 broad themes. I want to spend some time on significant role played by audit in enhancing the overall financial stability, perspectives on NBFC sector, and expectations from the auditors of NBFC. If you can see this slide, several aspects related to the supervision, financial stability, the role of various stakeholders, all these aspects have been brought out in this single slide. If you see whether it is a commercial bank, NBFC, or an urban cooperative bank, when it comes to the effective supervision, we look at it under 5 layers, what we call as 5 stacks. If you see the first layer of the effective functioning of a commercial entity is the business vertical itself. If you go to any NBFC or a bank, you can always observe that some sort of internal guidelines, operational controls, standard operating procedures will be there for each of the business vertical, whether it's, say, for example, retail lending, commercial lending. So each of the business vertical will have its own operating procedures, which it is expected to adhere to in the course of conducting its business. Over and above the business verticals, we are having the risk management department and the compliance function. Whether the business verticals in the course of their business activities are adhering to the controls, the systems, the standard operating procedures which are laid on as per the policy of the bank, whether these are being adhered to is being checked by this risk management and compliance function. Whether these two layers, that is business vertical and the risk management and compliance function, whether these two layers or two stacks are operating effectively as per the laid down norms is checked by what we call as internal audit and vigilance. You can see as we progress, we are observing the overall framework or the overall context in which the business is being managed is gradually taking a pyramid shape. We normally in supervision parlance, we used to call these three layers, that is business vertical, risk management and compliance, and the third one, internal audit and vigilance, as three layers of defense or assurance functions. We call them as assurance functions or three layers of internal defense. Now, over and above these three layers of internal defense, we are having the statutory and external audit, where you are playing a very significant role. We are considering the auditor as the first line of external defense or the fourth line of internal defense. And over and above these four layers, the supervisor comes. You can observe that you play a very vital role as a link between the supervised entity and the supervisor. So in the input, the returns, whatever you are submitting to us or to the bank, it gives vital inputs which will help us to formulate our supervisory strategy for the overall system as well as for the individual supervised entity. Now, as a supervisor, we are using 5 major tools. You can observe that off-site surveillance, on-site inspection, market intelligence. The fourth and fifth one is very important. Reports of the statutory auditors, annual report, statutory auditor certificate, exception reports, etc. And the fifth element, active engagement with other stakeholders, where we are talking about statutory auditors, then MCA, CACs, etc. If you can look back my initial introduction, I told you that over the last 1 year, both the number and quality of interaction with the ICAI has gone up substantially. This you can link it with the fifth element. So we are consciously taking steps to ensure that there is periodical, fruitful interaction with the ICAI, and we attach a lot of importance to the feedback from you, which comes through our interactions as well as whatever is given in the documents which you are submitting to the banks, right from your annual report, your SAC, all those things. With this broad perspective of how important role you are playing in the entire financial stability and how you are aiding our supervisory process, let me go to my second broad theme, that is a broad perspective on the NBFC sector. You will be observing that this sector, the NBFCs which are registered with RBI itself runs to around 9,600 entities under 12 categories. Deposit taking, non-deposit taking, P2P lending, accounts aggregator. Like that, we are having several categories of NBFCs. And although the credit and investment NBFCs may be a major player, we are having equal importance to all these remaining categories of NBFCs. And just to get an idea of the size, the size of the NBFC sector is 1/4 the asset size of the banking sector. So even size-wise also, it is an important player in the financial system. And over the period of last 5 years, you must have observed the assets growth is at the rate of around 18% per annum. So this tells us the size, scale, and scope. Scope, why I have added here is, if you see under the relevant sections of the Banking Regulation Act, there is a particular number of activities which a bank can engage. However, such a specified number of activities or the nature of activities is not there for the NBFCs. So it is a slightly a broader concept. So the flexibility related to products and services is more for a NBFC compared to a commercial bank. So that's why I've added the scope also. So now we are having a fair idea about the size, scale, and scope of NBFC sector, which I wanted to emphasize that this is an important player in the entire financial ecosystem. And now let me also add to it, it is having huge interconnectedness and systemic impact per view also. The NBFC sector, it sources around 30% of its liabilities from the banking system. And several occasions, they are partnering with the banks as a co-lending partner. And there are occasions wherein both the bank as well as an NBFC may be lending to the same common borrower. And in fact, there are several occasions where we have observed a bank will borrow from, NBFC will borrow from a bank and it will lend to the same borrower to whom the bank has already lent also. And as I told you earlier, the bandwidth for the activities is more flexible when it comes to an NBFC. And again, NBFCs, they are the largest borrower of funds from the financial system. See, not only from commercial bank, they raise deposits also from the public, and also through debt route also they raise from the market. And the other important one is the domino effect on small and mid-sized NBFCs. Without naming any particular NBFC, you must have observed when there was a crisis in one of the NBFCs, it had its own impact on the liquidity position of several small and micro-sized NBFCs. So any reputational risk of a large NBFC, it will have its own collateral effect on other NBFCs, especially for their borrowing activities. Now, with this, two broad framework in place, let me go to how we are evolving our regulation and supervision. We are broadly following with a lot of flexible elements what is called as principle of proportionality. That is on the basis of the size, activity, and riskiness of NBFC, we calibrate our regulation and supervision. Further, we are also taking steps continuously ensure that the board and the top management of these NBFCs are sufficiently empowered and they take adequate responsibility when it comes to the prudent functioning of this NBFCs. And in this direction, we have issued several sets of instructions in the recent period, wherein we are classifying these NBFCs into 4 buckets. And the buckets normally will come in the base layer, middle layer, upper layer, and of course the top layer, where so far we are not put any NBFC. But the idea is, based on the scale and the type of activity and the riskiness, which includes the interconnectedness, we are bucketing these NBFCs. On this broad thrust, we are moving towards risk-based internal audit for these NBFCs also. And if you observe our April 27, 2021 guidelines, which we issued on appointment of SCAs, includes NBFC sector also, which tries to say that when it comes to the independence, avoidance of conflict of interest of auditors, we are treating commercial banks, NBFCs, and all on the same platform. So with this broad perspective, let me move to the third element of my discussion, which is the expectations of RBI. I just made a brief reference to this April 27, 2021 circular. In that, I mentioned about the independence of auditor, avoidance of conflict of interest, joint audit. Several aspects have been covered in the circular. So the first expectations of RBI is, we are emphasizing the importance of auditor independence. If you observe, unless we empower the auditor to function independently, it may have a lot of creditability issues on the financial statements. And as I told you in the first slide, we also formulate our supervisory strategy and tools on the basis of the creditability of financial statements. So the emphasis on auditor independence is to ensure that the financial statements are true and fair and reflect the complete position. And also what we have done is, in order to ensure that the independence of auditor is ensured, side by side, we are also enhancing the stature, authority, and independence of the assurance functions. Again, I'll briefly take you back to the first slide. So the idea is, parallelly, when we are enhancing the stature, authority, and independence of assurance functions, that will also help to ensure that the auditor's independence is accordingly assured. Then I'll take you to the second item. This, you are very much aware that the nature of audit is changing in a very rapid way. If you see the dynamic nature of the business model of the NBFCs and the resultant risk profile, you take my second slide, where I told about the bandwidth available to the NBFCs as regards what type of products and services they can offer, is slightly better or more compared to a commercial bank. So depending upon the need of the customers, they are able to rapidly tailor make the products and services and give it to them. So while they can rapidly modify or calibrate their business model, what may be any resultant residual risk will evolve only over course of time. So neither the NBFC may be aware on a real-time basis how a revised business model may impact on the overall risk profile, that they may not be aware in the initial stages. But some residual risk may come out in subsequent stages. So when we look at the audit of NBFCs, the auditors may have to closely look at the dynamic nature of the business model, how the business model of this particular entity is evolving, whether it is going too aggressive in a particular product or a particular service, or whether a particular product service is a major component of its entire asset side, or one particular product or service is growing up in a very big way in a very short period. All these things will give us a clue whether a robust, well thought out business model is in the place. If we are convinced about the business model, then we can have a fair idea about what may be the residual risk profile. But if we are not clear about the evolving business model, there are chances wherein we may be left out with a residual risk which remains unattended or unmitigated. So the auditor may have to look at the business model, and also he will have to have a forward-looking assessment. When I tell forward-looking assessment, it is inbuilt in several ways. If you look at our ECL model itself is based on the forward-looking assessment of the credit risk. So we'll have to have a forward-looking assessment of not only the credit risk, but also the business model and the residual risk. And one more example, what I can give about the changing business model is, now in a big way, NBFCs are partnering with fintech firms and other service providers also. So now, when they're partnering with fintech and other service providers, several times we really don't know where the exact risk is lying, whether the risk has been fully available with the NBFC itself, or the fintech and other partners, they have taken a part of the risk. This has got several connotations. One is not only the exact nature of what risk is retained with the NBFCs and what risk has been passed on to the service provider. It will have several connotations when the actual risk devolves. What sort of provisioning arrangement and what sort of capital impact it will have on the functioning of NBFC. That is one. And if at all, if some risk devolves on the NBFC, whether the NBFC's risk management system is fully geared to meet the devolving risk. These are all the aspects we may have to see when it comes to the NBFCs partnering with the fintech and other service providers. The service providers, they provide a lot of products. You may be observing that one such recent product is a first loss guarantee scheme. A lot of discussions going around when somebody says, I am providing you first loss guarantee scheme, where the risk is exactly lying with the NBFC or with the service provider. Like that, when they are engaging in a big way with the other stakeholders, we should know what sort of risk is being assumed by these NBFCs. So this idea is about the changing nature of audit. Now I'll continue with some of the other expectations from the auditors. We have given our guidelines on the role and responsibilities of the joint auditors. Now, what we are observing, from the market, the feedback what we are getting is, there are several occasions where the role and responsibilities are not clearly defined and demarcated, or it is the clear definition demarcation is not done on timely basis. So, when it comes to the, even at the time of closure of the audit, there are certain gaps like who will do which sort of activity, who will do which sort of activity. So my request is, if we want to really make this joint audit system a successful one, then in the initial stage itself, all the stakeholders, the supervised entity, the auditors, they should sit together and arrive at the roles and responsibilities in a consultative approach. So there is no ambiguity or gap during the course of the audit or towards the end of the audit. Then similarly, we'll have to see whether there is a material misstatement. Here, the idea what I wanted to say is the facts and figures will be giving a picture, but the underlying theme may be giving a different picture. So somebody may be giving us appropriate numbers to us, but whether these statements are reflecting the complexities of activities which are being undertaken by this NBFC. If you can kindly recollect the previous one, which I was talking about, the forward-looking element, the type of activities they are taking, the type of tie-ups they are having. So we'll have to see in toto whether the statements are reflecting the complexities of activities being undertaken, as well as whether the supervised entity is adopting a consistent approach in accounting policies and practices. Why this is important is if there are several new business activities it is taking up and also several new tie-ups it is having, whether the risk is properly identified and adequately provided for has to be seen below in a nuanced way below these statements. Otherwise, by numbers it may be correct, but the complexities which is underlying these activities may not be captured properly. Similarly, just because a new product is being launched or the bank, the NBFC is going in an aggressive way in the business approach, it should not be inconsistent in adoption of accounting policies and practices. So irrespective of the business strategy or the tools which it is employing to achieve the business strategy, there should be consistency in adoption of the accounting policies and practices. When it comes to IFC, in a similar forum of ICA, I said in coming days, the efficacy, the veracity and effectiveness of IFC and CARO is going to play a very big role in ensuring that the supervised entities are able to prepare their financial statements in a consistent and a comprehensive way. I will repeat this point. Going forward, effective implementation of IFC and CARO is going to be a very significant tool in the entire audit process of our auditors. I would urge again the audit community, please see in your respective supervised entities whether this IFC is appropriately implemented and whether the auditors are able to leverage the various returns under CARO for their effective audit. Now I'll come to the other major issue which is in my mind. That is, there is this communication channel between the auditors and RBI is always available when there are significant deficiencies or gaps observed in the functioning of the supervised entity in the course of your audit. Please see that if there are certain significant issues which requires to be flagged to the Reserve Bank of India, the channel is always open for you. So it need not wait till it goes through a formal channel in the supervised entity. Auditors can always flag such concerns which are significant in nature to us, and it will not only it will give us an idea like certain gaps are there which requires urgent attention, but also it will help us to formulate our business strategy. Just a minute. And now certain persisting concerns and gaps I have given here. Due to paucity of time, I will quickly read out those persisting concerns and gaps. Once I am through this remaining few slides, any questions and suggestions, not only on my presentation, but anything related to our audit regulation, you can raise to me. So the first persisting gap is again related to delay in submission of forensic audit reports and inconclusive observations made in the reports. Then still, with a lot of efforts, even now we are not able to, really find out in timely basis the diversion of funds and our transfer of profits to connected bodies through various modes. And even now, the fraud prevention and mitigation mechanism in the NBFC sector is not very robust. And several of them, they are still following smart and innovative accounting practices, overstating of profits or understating of the expenses and liabilities. And as I told you, there are several MIS related issues also, layering of transactions, maintaining of separate sets of data for management, regulators, and auditors. I sufficiently talked about aspects related to ECL, and I have given the granular areas in which there requires to be a lot of improvement. Then another dark box for us is the unauthorized operations of internal and office accounts. And I have told like what is lacking there. There is no system-based checks and controls, lack of monitoring of the position of balancing of accounts, operations control, and internal accounts opening processes, etc. And of course, I have got a couple of slides which by and large we have already shared with our ICAI, which talks about the typical reasons for divergence observed in asset classifications. So these slides, you may like to go through. Anyway, we have already shared with ICAI. So with these remarks, let me now conclude this presentation. I will leave the forum open for further questions. Thanks a lot.
Thank you, sir. So we've received a couple of questions, sir. So I'll take a few of them, and then maybe afterwards. So, sir, one question is like, as you mentioned about the joint auditors, so they are saying in case of joint audit, whose responsibility is to sign the statutory auditor certificate in XBRL format? This is, they are saying DNBS 10. Can the audited NBFC define it, sir? So this is one of the questions we've received. And sir, you like to answer one by one?
Yeah, I would like to go one by one.
One by one. Okay.
Yeah, this one we are noted down. This particular query we are noted down.
Right, sir.
We will revert to you.
Right. Then, sir, our members have read, what is the best way to approach RBI if, as an auditor, certain issues are to be flagged? They are saying like how to approach directly RBI if certain issues have to be flagged. So this one specific question we've received.
Just a minute. Let me try to answer this question.
Okay. Right, sir.
One is, if you observe, most of, in fact, all of the commercial banks and several of the major NBFCs, they are having dedicated senior supervisory manager. And in fact, for commercial banks, we are already having a quarterly interaction between the senior supervisory manager of RBI and the statutory central auditors. So one such forum, you can always flag it to them, or otherwise also at any point of time, you can flag it to the SSM, that senior supervisory manager. In addition to that, there is our supervisory examination division for banks, NBFCs, and UCBs. So this can be flagged to the supervisory examination division, senior supervisory manager, and even if it reaches us, we will also forward to the respective senior supervisory manager, the supervisory examination division for their examination. Here, in addition to the mode, we are worried more about the timely flagging of the issues to us, so that before any issue gets out of control, it is better we should try to mitigate it at the incipient stage. So we can effectively use the SSM forum, supervisory examination division, and audit relation group also can be leveraged. Yeah, please. You can continue.
Okay, sir. Okay, sir. Then, sir, we've received a question that how to raise debt or the sources of a new NBFC. Also, what are the compliance requirements for a newly registered NBFC? Although we have a separate session also on that, sir. But this specifically, this question one has raised, and or maybe we could take it afterwards also, because this we have a separate after your session, a session on this also. So we could take that time.
Yeah, in fact, this is a lengthy and a comprehensive process. Probably
right.
at one point of time, we may not be able to, give a comprehensive answer. And if you can observe, I told, there are several aspects depending upon whether it is a deposit taking NBFC or a non-deposit taking NBFC, what activities it intend to take up. So there several aspects are there when it comes to the entire, the registration process. So what I would suggest is, in case post completion of the session, what you have proposed, if there are specific queries on this, please email to us. We will get in touch with the concerned supervisory examination division, get the inputs, and we'll forward to you.
Thank you, sir.
Okay.
So, so just one last, if you have time, we'll take it, and rest, sir, we will send it to you. So they are saying that what is the independence of joint auditors in charting out responsibilities vis-a-vis the management of NBFCs, as scope of audit is generally laid down by management, sir. So because since the scope they are saying is laid down by the management, so what is the independence of joint auditor in charting out responsibilities vis-a-vis the management of NBFCs? Although, sir, you had covered also in your slides, sir. So if you could.
Yeah, thanks for the question. In fact, if you can kindly see the wordings, what I used is, as regards the scope, we don't want to intervene at any stage, because the scope will be decided by the management on the basis of the factors prevailing in that particular, supervised entity. So the idea is, the scope, let it be decided by the auditors along with the management. Our only concern is it should be done timely, and each of the auditor is aware of what is the role and responsibility for it. So we are harping on the timely identification of the role and responsibility for each of the auditor, and that should be there without any gap or ambiguity, so that during the course or towards the end, they are not, there should not be a view that we are not clear, like what is the role from us. As regards scope, we may not be able to intervene, because it will be decided by the management on the basis of the existing line of activities and other factors. In special circumstances, we may be asking the management to include certain aspects in the scope, but in the normal course, it is for the auditors and the management to arrive at the scope, and large role will be for the management.
Thank you, sir. And so rest of the questions we could offline, we could share it with you. And there is one, sir, there is just one question. Is there any standard credit rating of NBFC borrowers mandate issued by RBI? So they are saying any standard credit rating of NBFC borrowers mandate which has been issued by RBI, sir, on this.
I don't think we have exclusively issued for the borrowers of NBFC. The borrowers in the financial system, on the basis of various parameters, they are being assessed by these rating agencies. For NBFCs, for borrower exclusively, I don't think we have issued. But for some of the SME borrowers, it appears that SIDBI has issued some guidelines, but definitely for nothing exclusively for the NBFC borrowers. If I get some details over and above what I told you, I'll revert to you.
Fine, sir. Thank you so much, sir. And now I'll request Prasanna Kumar, sir, Vice Chairman of the Professional Development Committee, and also the convener of the UDIN Directorate, sir, to please propose a vote of thanks. Prasanna Kumar, sir.
Yeah. Thank you, madam. Madam, I'm audible?
Yes, sir. You are audible, sir.
Yeah. respected Madam CAK, Kamisha Soni, the chairman of the Professional Development Committee, and today's speaker, very good friend of mine in one day, within one day, Mr. B. Sivakumar. I met him for the first time in a CAG meeting, which was convened on 5th of September. We had good interaction that time. So we became very good friends also that time. So I've seen a great friend for ICA in him with the Reserve Bank of India. And he is the person who is we got a line of connect with our Reserve Bank of India by virtue of the round table which you are having on a quarterly basis, and it has been spearheaded by him. So thank you very much, sir. So though I was not in the initial remarks when Madam made, so I too welcome for the first program you are attending as CGM, the ICA program. We expect many more to follow of this kind, sir. Sir, your presentation, as you're aware, as auditors, we are highly knowledgeable. We are knowledgeable in audit function, giving opinion, reporting everything. But today, you are taking us through the rest of the things which you are not aware of. So that is a great chance today's meeting, your offer interaction, as you have taken through the size of the NBFCs and the scale, and the growth prospects, and what is their size in the entire banking industry in the country is a very good information, sir. And also you are taking us through the importance that you are attaching to this particular function, NBFC. When the circular has come, sir, we did not understand why RBI is coming with a new circular for NBFC and for appointment auditors, everything. But we understand why the importance is given to the NBFCs, because they are accounting for 25% of the entire banking sector. And also the independence auditor, joint audit, it has got a lot of meanings, sir. So we did not understand the purpose for which it is done. Today, through your presentation, we came to know about everything and the importance of the entire NBFCs, because they have got a flexible way of lending, and also their business model is dynamically changing. And what is going to be the risky element about that one? All this will certainly get into your mind. It is going to give a lot of value addition for the audit. In the way in which we conduct the audit, we'll have a new leaf will be open with your presentation today, sir. Thank you very much. And ultimately, expectation gap. What exactly you expect? You are so presented so lucidly. So that is in our mind now. So certainly, when we are conducting an audit, this will certainly have a role to play so that the audit quality goes up. That is the buzzword today. So thank you very much. So thanks a lot to Sivakumar, sir. So we expect to have many more meetings with you. You have presented so nicely. Even a layman can understand what you are presenting. So very nice presentation. Thank you very much. Thank you.
Just before I sign off, I thank the ICAI Forum for this opportunity, and I wish the participants all the very success in this interaction. And I am also looking forward for such interactions in coming days. Thanks a lot once again. Thank you.
Thank you, sir.
Thank you so much.
Thank you so much, sir. Thank you. So we're continuing with our proceedings for today, and we'll be taking our technical session starting. So I'll request CA Vikas Kumar. He'll be taking on key aspects in NBFC audit, and my colleague Neha will introduce us, sir, and we will carry forward the proceedings.
Vikas, how are you? I'm Prasanna Kumar here.
Yes, sir. Very well. How are you?
Thank you. Fine.
It's always nice to hear your voice.
Thank you so much. Thank you, Vikas. Very nice. Go ahead. Go on to the meeting.
Thank you so much, sir, and thank you so much, ma'am. So, good afternoon, everyone. Taking this session forward, I would like to invite our first speaker for the technical session, CA Vikas Kumar. He is a practicing chartered accountant having more than 30 years of experience in the field of statutory audit, bank audits, forensic audits, business advisory services of various industries. He is a regular speaker and expert panelist at many conferences and seminars organized by the ICI, SEBI, and CAG on various topics including Ind AS, Companies Act, bank audits, forensic audits, accounting standards, etc. He is also a member and reviewer of the many committees and board of the ICI. And today he will share his knowledge on key aspects in NBFC audit. So, sir, I welcome you in today's seminar and requesting you please start with your topic and guide our members. Thank you, sir.
Thank you so much, Neha, for giving a nice introduction about me. Thank you so much. And thanks a lot to ICAI for inviting me over here to talk on the key aspects of NBFC audit. So friends, as you all are aware, that today RBI CGM, Mr. Shivakumar, has already told with respect to the expectations which he has from the auditors. So we all must have heard him very carefully. We also have 2 more technical sessions to go, which will talk on IT side as well as in the regulatory side. So I will not talk on those items or aspects in my presentation. And what I have tried to do is that I'll try to focus more on some of the slides, of course, on the basic things, but I'll try to focus more on the practical aspects. When we do the audit of NBFC or when we do the audit of HFCs, what are the key common things which we are noting in those audits? We would like to talk more on that. And if there are any questions, I think it will be better to interact and discuss so that we can have much better understanding on whatever we are doing, because we all are together, we all have the same job to do, and we all have to ensure that together we do a quality work which is seen by the world and as well as the regulators as a good quality work from all auditors, right? So that's the whole idea in which we are going on. I think you can see my presentation.
Yes.
Yes,
You're able to see. Yeah.
Thank you so much. So going ahead, NBFC, as we have to talk about when we are talking on the NBFC audit. So what is NBFC is the first thing. We all know that, but still just going by what we generally perceive or what is the actual definition of the NBFC. So this is something which is a financial institution, which is a company, then it becomes an NBFC. Or it is a non-banking institution, which is a company and which has its principal business of receiving the deposits under any scheme or arrangement or in any manner or any lending thing which they are doing. In such case also it becomes NBFC or any other non-banking institution or class of such institution as RBI specifies. So if RBI tells something, then normally it becomes. Then second is on the types of NBFC. So key thing when we do the audit, we have to understand is whether it is a deposit taking or it is a non-deposit taking. Because then the regulation and the risk and responsibility changes significantly between a deposit taking NBFC and a non-deposit taking NBFC. So that we should always keep in mind. Second important thing when we do the audit is to check whether it is a systemically important or it is a non-systemically important. So that goes on the asset size. So we need to be aware whether what I'm doing is something which is defined by RBI as a systemically important or not. Because the moment it is defined as a systemically important, the guidelines, the regulations, the other stuff which RBI has told or given changes. So we need to be aware on that, right? Asset based, it has to be basically, we all know that the principal business has to be on the lending side and the financial assets should be more than 50% of the assets, as well as the income from the financial assets should be more than 50% of your gross income to be qualified as NBFC. Though our another speaker will talk more on detailing the regulations, I am just highlighting here that what are the key guidelines which are issued by RBI in this regard. If you see for HFC, they have issued a separate master direction. For NBFC, this is non-systemic important, they have issued a separate direction. And for systemically important, they have issued a separate direction. So last updated for HFC was 17th of August 22. For non-systemically important, it is 22nd July. And for systemically important again is the 22nd July. So these are the latest and the updated directions which are issued by RBI in this regard. When we start the audit, in my view, in my perspective, first thing we need to understand is that what are the policies or what are the governance norms or what are the controls which are in place with respect to any entity, including NBFC. So when we talk on NBFC, there are various guidelines, there are various policies which RBI has told that the NBFC should be in place. They must have those policies in place and those policies should be approved by their board of directors. So that is something which is expected to be there. It has to be there. If it is not, then that has to be the starting point for you that this policy is not there. Because this is something which is mandated by RBI and asked by RBI to be there in place, which includes like they must have a risk management. Like if you see when Shivakumar sir was talking, he was talking a lot as to how the risk is getting managed. So when you have to see managing risk, you need to have a proper policy in place. So the risk management policy and liquidity risk management policy flows from there. So the company needs to have this in detail, properly approved by board. And when you start the audit, you must go through and check that what this policy is talking about. Is that a comprehensive one? Is this complete one? Whether some elements are missing? If yes, then you have to highlight those things to the management and to the audit committee so that they can get it updated. Fraud monitoring and reporting is again a very, very important element in any audit of NBFC, and hence a detailed policy is a must in that regard. How are they going to monitor? When they decide it is going to be a fraud, and once it is a fraud, then what is the reporting mechanism in the company? That's a very important policy. Credit control, the whole the gamut of the operations for any NBFCs on the credit which they give. So naturally, this policy becomes very important. Information technology nowadays and the IT system policy is again a very, very important and relevant. We have one more slide where I talk before you have a detailed understanding on IT from the other panelists. But if you see, Mr. Shivakumar was also talking that one of the key highlights which they have, which they want us to check, is whether the companies are having end-to-end solution for the entire loan management system, whether the classification of the loan as per NPA or not NPA, whether the provisioning, whether the CRAR, that is all automated or not. So for having that, it is required that you have a proper policy first in place. So again, that becomes a very important. AML and KYC, you all are aware on the importance which the regulator or the government focuses on that. And if my KYC is weak or my AML is weak, that may also result into a fraud happening in the entity. And again, that becomes a very important policy. All the entities which are under Ind AS, the ECL, because they have to do the provisioning as per ECL. And as you know, ECL is something where there are a lot of ifs and buts which are in place. It is not as straightforward like it has become substandard, you have to do 10%, or it has become doubtful, you have to do 25%. It is not like that. So there is a lot of subjectivity into it. And hence a detailed policy for ECL must be in place. And the last one, which I can say, is on the asset liability management. So friends, these are the key policies, minimum policies, which should be there apart from other ones. We must go through them. We must have a walkthrough of it. We must do a proper understanding with the key process owners, understand it, and accordingly plan and do the audit. That's what my suggestion on the audit side would be. Another thing which I believe is important when we start the audit or when we plan the audit actually is to see two things. Number one, the inspection reports given by the regulators, the last inspection report, because those reports will talk on what regulators itself have already highlighted with respect to the entity. And if there are issues which are already highlighted, naturally you will have to dovetail them in your audit plan to ensure that when you do the audit, those things are absolutely taken care of because the regulator has already highlighted it. Second, we must go through the returns which are being filed by the entities, whether NBFCs or HFCs, with RBI, and in case of HFC with NHB as well, National Housing Bank as well. So whatever returns they are filing with the regulators, we must go through to understand that what data they are reporting, how they are reporting, and whether it is getting matched with what we are seeing and the way we are planning and doing my audit or not. Because the data is already there with the regulator. If there is any difference as compared to what is already reported and as compared to what is going to be in the financial statement, naturally it is going to be viewed very seriously. So this again, in my view, becomes a very important element when we plan and when we start our audit. IT structure, as I was saying, which RBI CGM was also talking about, that it is expected that there should be an end-to-end automation. And that end-to-end automation must cover all the asset classification, provisioning, ECL computation, DPD, one bad, one good, day-wise stamping, upgradation. There are a lot of elements while doing the provisioning part. And for all of that, because most of those NBFCs are those which will have large number of people, manually it is going to be very challenging. So, and then you have to have the audit trail if there is manual, what changes has been done, who has done, what is the basis for it. It becomes very, very challenging when it is anything which is manual. And hence it is expected and required by regulators that this entire thing should be automated end to end. And wherever, and frankly, we are like involved with 8 NBFCs are allowed and we're doing that, but you see, you find a challenge in that. Except from some large ones, in many NBFCs, this is still a challenge, not yet done. And hence it is important that we give proper focus on it, push management to do that. Wherever it is not there, we must put it in our presentations to the audit committee so that we are telling where are we and what is going on and how do we really go about it. And relating to IT itself, the companies are also expected to get a detailed system audit done by experts to check and see that, yes, whether their systems are functioning properly, there is no other vulnerability, the reports generated from application softwares are proper, and various other elements which are there. That should be happening in the NBFCs of a good size. We must go through those reports and see if there is any impact of those items which are open on our audit procedures, and how do we really take care of that. So this, I believe, will be very important from our audit perspective. Friends, going forward, credit assessment. NBFC ka kaam kya hai? They are lending the money. When they lend the money, if the money doesn't come back, that is where the biggest risk is. And to see that when they are lending, they are doing it in a proper manner. They need to have a very robust process of doing the credit assessment and sanctioning and disbursement. That itself will determine ultimately how the company is going to focus. So naturally, as an auditor, it is most important for us to see that what is the process of credit assessment in the respective entities, how they are reviewing the financials, promoters' backgrounds, company background, what peer review mechanism they have, how they are doing the evaluations of their performance, prelic check whether they are doing or not. One of the important things is security. So what security they are taking at the time of giving the money, and whether that security is getting charged in time to the lender in case of any need. So that is very, very important to be seen, that how they are doing the security evaluation. Is there any loophole which may result into showing some higher value, and tomorrow the companies have a challenge? So that becomes very important. Similarly, the ALM profile of the borrower and their balance sheet items for the larger ones. Back-to-back arrangements, what I meant here was that, as you are aware, now we have to specifically comment that whether we have given, and I mean, we means the entity or the company for which we are doing audit, whether they have given any money or taken any money with an understanding that that money will go to somebody else or will be received from somebody else. If there is any such arrangements, that has to be specifically reported in our audit report now. So this we have to see when we are doing the credit assessment. They are saying, are they mentioning something which reflects, or is there something that it will go to their group, or this is the purpose is to get from group, or anything like that, where any back-to-back arrangements are there, it will have to be seen very carefully, because we have to report specifically in our audit report now. And this becomes most important for NBFCs actually, because there are chances that there could be back-to-back arrangements. Another thing we have seen, like guarantors, like most of the cases, they take guarantors, but the evaluation mechanism in certain entities are not that robust. It has to be robust enough, like the way they do it for borrower. So that is something which we must focus. And ultimately, all of them has to be as per the board approved policy, which we have already talked about. In any NBFC, friends, there is one of the risks which as an auditor we have is of the ghost borrowers, in a sense that those borrowers are not existing, but on paper they have completed and given money to somebody. To see that we do not have any such risk, we should have a good sample. We can't do 100%, that's not feasible and possible, but we should definitely do a good sampling size and review those files with all the documentation end to end to check that yes, these are looking to be a proper borrower and proper and genuine borrower ultimately. So this is something which I believe is very important so far as the credit assessment is concerned. As we have been talking, another focus area from the regulators or from the government, as well as important from the companies, KYC. Now, KYC guidelines have to be followed. Most of the large NBFCs will have their good internal control system as well as outside auditor checking with respect to whether the KYC is being done properly or not. We need to see that process and satisfy ourselves that yes, the process is fine and it is going fine. One specific issue which we have seen in this case, which I would like to highlight to all of you, is on the co-lending business. Wherever there is a co-lending, many of the times the NBFCs, what they do, they are relying on the KYC done by the other entity with whom they are doing co-lending, which is not something which is expected as per the regulatory guidelines or even otherwise, because the risk is yours. If the risk is yours, you have to do a proper KYC, irrespective of whether your co-lender has done that or not. So that is one area which we believe must be focused upon, to see that they are actually doing a proper KYC. They are taking the details of the borrowers, their addresses and other stuff, and that is on the record of the NBFC. They are creating the unique customer identification code for them. They are doing their CKYC. So all that for co-lending should be specifically focused upon. few issues which we have seen and which needs to be focused upon in our view. One is like due date. So as you must be aware, there have been differing practices in the industry, wherein they have mentioned date X in the agreement or they have not mentioned, whereas they are asking the borrower to pay the money as per Y. So then the dispute comes. What is the actual date of payment? Like the agreement may say my due date is 30th of each month, whereas I'm asking the customer to pay on 5th of each month. When they are doing the classification, they are saying my due date is only 30th, so I will do the classification as per 30th. Whereas in practical sense, they have asked the customer to pay on 5th, and if they are not paying, they're saying them reminders and other stuff. That is why the RBI came with a regulation saying there has to be one date only. And that one date must be specified in the agreement in the clear terms with the repayment schedule that what amount is becoming due when. We need to check and audit because of this specific requirement now that this is being done not only for all the prospective cases, but even if there were earlier cases, if there is where the due dates are changed, were different, it has been aligned. So that is something which is critical and important from the customer perspective as well as the classification and NPA provisioning perspective. So we must focus on this properly. Another issue which we see in any lending company, including NBFC, is on the valuation of the underlying property. Now, again, what is the requirement? The requirement is that NBFCs must have a board-approved policy. There should be clear guideline given by their board of directors how they are going to do the valuation at the time they are lending the money. Similarly, at respective intervals to check whether the valuation of the property mortgage to the NBFCs are proper or not, right? Like the frequency as defined by RBI is only for substandard asset. That for substandard assets, it has to be annual valuation done. For others, they have not defined. So who has to do that? The board of directors has to define what they believe is the right way. We as an auditor must definitely see that whatever they are making the policy is fair. It should not be an unfair policy. Policy should not be that I will not do the evaluation of any of the non-standard asset at all. I mean, there has to be some justification for whatever policy is. Similarly, like if there are any repossessed assets, you may find in some of the entities which you are auditing that they repossess the asset. Once they do the repossession, then the normal IRAC norm or ECL provisioning doesn't come in play because that has been shown separately. But in those cases also, it is important as an auditor for us to see that proper provisioning is done and what is expected to be recovered is only being shown over there. How would we do that? Again, we will need to have proper valuation of those assets which has been repossessed by the NBFCs. Many NBFCs will have technical internal valuers. Those are allowed, but their qualification should be similar to what is prescribed under the company's rules. So we should see that it should not be that people who are not certified or people who are not qualified are actually giving the value, and based on those values, the data is being reflected. So that is the important thing which we must see about. Next issue, friends, which I think I can talk about is the multiple exposure on the same property. What do I mean here is that there is one security on which one loan was given first, and there are then top-up loan or other further loan has been given on the same security. Now, if in the system, suppose you have given first 10 lakhs and security value was 18 lakhs, you have mentioned 18 lakhs as the security value. Next time you have given another 7 lakh and the same security is there. Again, if you show it as 18 lakh, it means for the same properties coming twice in your security value, and the LTV ratio, CRAR, all will go wrong. So whenever there are multiple exposures on the same property, the proportionate amount of the security only should be shown as security to have the right results and to have the right data in place. Next issue I can say is like funding of processing fee and insurance amount. So many cases, friends, when some NBFC is lending, they ask the borrower to get the insurance also, because in case something happens to the borrower, the NBFC would like to be secured. Similarly, there is a requirement for the borrower to pay processing fees also. We have seen in many cases this amount is not being recovered from the borrower, but this is separately funded and recovered. So there is no bar in doing that. The NBFC are free to do that and do that funding as per the norms. But such cases, in case of housing finance companies specifically, should not be treated as a housing loan. There is a very clear guideline in that regard. It should be classified as non-housing loan. And the provision for housing loan as well as non-housing loan also differs. So it will make a difference not only for disclosure, but also for provisioning. So this should be something which again should be taken care of. I hope I am clear so far and you are all able to hear me properly and going fine.
Yes, sir. Yes, sir.
Okay. Friends, next, again, we have seen that cases when the NBFC lend money to someone. In some cases, the EMI starts immediately. In some cases, the EMI doesn't start and it is dependent on certain things. Like if you are given money for some construction, now you are saying that, okay, till the time construction gets completed, you will not be in a position to pay me principal, fine. So keep on paying interest to me. And once the construction is completed, then the EMI will start, which means the principal repayment will also start. No problem in that. But 2-3 things. Number one, we should have a proper board approved policy. Number two, it should not be treated as a tactic just to delay the start of the principal repayment. So suppose you have given a timeline of 2 years for some construction to happen and then the EMI to start. If they are not able to do that, maybe few genuine cases you are giving them another 3 months, 6 months, but it should not be perennial. There has to be an end date, a max date, after which it will not be continued as a pre-EMI and the principal repayment should also start. This is just one small point that if there are some money given for plots, especially for HFCs, and the construction could not start even after the timeline of 3 years, it should be reclassified as non-housing loan and provisioning to be done accordingly. Okay, friends, going a little fast now. Few things on NDS. In many HFCs or NBFCs, you will find that they do direct assignments in a sense that their asset, their lending, which they have done to their borrower, they sell off those lendings and those borrowers to other lenders, right? They are supposed to keep 10% and up to 90% they can sell it. What is allowed as per Ind AS is that in case of such sales, what profit you would have earned or you were expected to earn on these assets, you need to do the discounting and recognize those profits now itself. So something which you are going to get after 2 years, 3 years, 4 years, 5 years, you will be able to recognize that income now with the proper discounting. Now, the challenge what comes in such cases is what life you are considering for those assets. Many entities consider the actual life which was contracted rather than the estimated, whereas India says that it has to be expected life rather than the contractual life. That must be seen, otherwise higher income will get booked, which is actually not going to happen. Second is on the discounting rate. Again, on the discounting rate, many people will have different views, but this should be something which should reflect the discounting rate for that pool and not the overall borrowing for that for that entity, but the underlying pool rate should be considered rather than the average borrowing rate for the borrower. That's the general view which we have on this direct assignment deals which happen. The next is on the amortization of income and expenses. Again, you all are aware, you have been doing the audit as per Ind AS, that the incomes have to be amortized, the expenses have to be amortized, and accordingly, this has to be recognized rather than the total amount of income and expenses. Now, how do we really go about it? The period of amortization should be the average folio life. So if you're the contracted again could be 15 years, 10 years, 12 years, but the average folio life is 5 years, then you have to see that. Like HFC, generally we understand in the industry from the industry that it is 6 to 7 years. So nobody else should be doing beyond that unless until there is some very, very specific data to substantiate that for me, it is actually 8 years or 9 years. Otherwise, this is the general trend in the housing finance companies. For other NBFCs also, what is the trend in that industry, we have to see. Otherwise, based on the record of the borrower, we have to see that what should be the average life considered for this. Rate again should be the average rate of the portfolio. Method, it has to be reducing balance method rather than the straight line method, because this being much more scientific to do the amortization. Some entities do that as a straight line method for the sake of more easy way out, but we can't look for easy way outs. There has to be more scientific way in which we have to work about it. Similarly, on the what are the components for income, as you are aware, it like processing fees and other directly related income expenses. It will be like DSA commissions, SSI fee, legal fees, incentives which are directly related to the sale. Those type of things can be considered as part of the expenses. we need to check and ensure that whatever income and expenses we are amortizing and not charging directly to P&L are such which are absolutely and directly related to the deals which are happening. The other common expenses should not be amortized, and it has to be charged immediately to P&L. Few other things like my review mechanism post disbursement also has to be robust. We have seen that when you sanction loan to anybody, you take security documents. The original security documents are there with you. Their custody of those documents becomes very important, because if you lose it tomorrow, the borrower can lodge claim against you, the NBFCs, and recover amount. And there have been good number of such cases with various companies which has been seen, and there have been various losses to NBFC. So the whole process on that needs to be strengthened and controlled. Fraudulent cases, again, we as an auditor, we must go through that. What are the fraudulent cases identified by the company itself? What is their mechanism for that? And whether the company has done a root cause analysis for all the cases which are already identified. And based on that analysis, whatever further updation in the policies or other stuff has to be done, whether that has happened or not. One important issue which in this year specifically will be there is with respect to all the restructuring which is done under COVID, right? So if they had done the restructuring, so they had a benefit of showing the account as a standard, but they had to have additional provisioning as per RBI guidelines or even as per ECL norm. Those provisioning should not be written back other than what is required as per the record of recovery based on RBI guidelines. That RBI guidelines says if you recover at least 20%, then you can recover half. You recover further 10%, you can reverse another half. So that is what is there as per RBI guidelines. It should not happen 1 year is over, now I'm reversing, only 10% I have recovered, I am reversing. No, the reversal has to be as per the RBI guidelines. That again is a major issue this year. We have to have full focus on that issue when we do the audit. Many NBFCs will have cash collections because many borrowers are small ones, and there are regular cash collection. Many cases, the check bounces, NACH bounces, and the NBFCs approach and collect cash. There's no harm in collecting cash. There is no problem in collecting cash. Beyond point, we have to have the PAN number and a PAN card and other stuff to be insured as per regulatory guidelines, fine. But the important thing is, what is the control of the NBFC in that regard? How they have defined their policies, who will go, who will collect, from where he will issue the receipt, when the message will go to the borrower, when the accounting will be done in your books of account, when the cash will be deposited in your bank, one-to-one matching, how it will happen. So those controls becomes very important because these are cash. So cash, this becomes important to have proper controls. Another thing which we have seen is on the penal or additional interest. So if any borrower is defaulting as per their agreement, they will have a right to charge penal interest or additional interest. Now the question is how the respective entities are doing the accounting. Are they doing it on accrual basis? Are they doing it on a cash basis? Number one. Number two, whether they are considering it for the purpose of classification as NPA or not. If there is any amount which is due and not recovered, how they are actually treating it for the purpose of classification and provisioning is the another important element which will have to be seen in that. I don't know how much time I have. Otherwise, the element which we have to do. ECL is nothing but a cash flow due to the entity minus the cash flow which the entity expects to receive. So whatever is the difference is become ECL. And as Mr. Shivakumar was also saying, that its ECL should not only be based on the current condition, but also the reasonable and supportable forward-looking information will have to be seen. So this is a critical piece which we believe in many cases the companies as well auditors miss. That it is not something that, okay, last 5 years, this has been my trend. That's fine. That 5 years has been the trend based on which you're calculating the ECL. But you will have to how the economy is doing. If the economy is not doing well, and it is expected there are going to be more defaults because the economy is not going to do well and the people will not have cash to pay, we will have to factor that. We'll have to factor all those forward-looking information while deciding on the ECL. IREC norms, I think you all are aware how the provisioning is to be done. I'll not spend much time on that. We'll just go fast. Similarly, on the ECL, basically on the stage 1, we recognize based on the 12-month period, whereas for stage 2 and stage 3, we take the lifetime cycle. That's the only key difference which happens between these two provisioning methods. These are the other specific things that how we have to calculate the ECL also on the undrawn commitment. So if there is something into the commitments amount not given to the borrower, and that then also we will have to include that as exposure in calculate ECL. Whereas for IGAP or for RBI norms, it was not included, but for ECL purposes under Ind AS, it will have to be included. Last slide that you all should be aware, as RBI CGM was also saying, that there is a separate reporting requirement in case of NBFCs. Apart from the audit report which we issue to the board of directors as per Companies Act, we have to issue a separate report under para 69 and 70 of the master directions of RBI, and that there are specific questions which have been asked, which will have to be answered, all of them. So those are separate checklists, separate work which we have to do and answer all those questions. And this report has to be addressed and provided to board of directors. In case if there is any unfavorable or qualified comment in our report, we will have to send to RBI and NHB or the respective regulators also. If we miss that, we may get notice from the regulator at any point of time. So we will have to be really careful and ensure that we submit this reports in time if there is a requirement and if there is an unfavorable or qualified comment. That's it, friends, from my side. If there are any questions, I shall be happy to answer now.
So we'll be taking the questions at the end of the session, all the 3 sessions actually. And then everybody can answer the questions respected to their expertise. And thank you so much, sir. It was indeed a very great session. And we're very happy to have you on as the panelist. And now I would like to introduce CA Manish Sampath, sir, for the second technical session for the webinar. CA Manish Sampath is a commerce graduate from Bombay University and has been practicing chartered accountancy and has more than 26 years of experience in the field of audit and assurance valuation and due diligence. He has been a part of many groups and subcommittees under the AASP, ASP, as well as under the other committees of the ICAI. He has contributed his knowledge in the revision of the guidance note on bank audits and is a part of the expert panel to address the queries of members regarding the bank branch audit. Currently, he is also involved in developing the study material for the Center for Audit Quality initiated by the ICAI. Today, he'll share his views on the topic, recent regulatory changes relating to NBFC. We welcome you, sir, and you can start your session.
Thank you. Thank you very much for the kind words. And first and foremost, good afternoon and welcome to all the participants. And it's indeed an honor to sit alongside my friends, my fellow speakers here. Always nice to be with Vikas Kumarji and Sandeep.
So hi Manish and hi Sandeep.
Hi. Yes.
Yeah. Please carry on. Sorry.
Thank you. So friends, when this particular topic, I was requested to talk on this topic, I was more than happy to take this topic because the recent regulatory changes, no doubt we've been hearing that there has been a vast amount of regulatory changes as far as NBFC is concerned. But I had just was aware of it and just read it. But this is the chance when I got to get into it, get deep dived into it. And therefore, these regulatory changes, which I'm going to highlight today for the next 20 or 25 minutes, whatever time I have in hand with me, is more of futuristic because all these regulatory changes, dynamic changes are applicable from 1st of October 2022 onwards. So I think so. It was a chance that I also got to do a deep dive and go through that regulations and be aware. Friends, can my screen be visible? Is fine?
Yes, sir.
Fine. So moving forward, the recent regulatory changes. Though this is the agenda for the day, as was mentioned, the recent regulatory change, that the most important change which has come, probably if you sit to discuss it threadbare, it could be a full day's seminar, or it would take more than that also. But I have been requested that you have to play a T20 game and try to finish off the game in the next 20 to 25 minutes. So I'll try my best at that. What the agenda for the day, what I have thought of is the new regulatory change that the RBI came out recently in October 21 was the full change of regulation, how the RBI is going to regulate, supervise the performance of NBFC. So in October 21, it came out with this guideline or circular on scale-based regulation. So friends, in this presentation where I refer to the revised regulatory framework, or if I refer to the scale-based regulation or SBR, it would mean the same thing. So the other items which are also they are relating to them, because this October 21 guideline which was given is a broad framework, and subsequently other guidelines covering other areas of NBFC supervision, NBFC operations are given by RBI. So what I'll be covering naturally besides that is also the 12th November 21 circular, which speaks about the automation and the challenges that automation will bring about. So friends, this is the discussion for the day, and all other items and other slides will be taken care of that. So since we don't have that much time and I have to pack everything in about 20-25 minutes, I have a presentation of about 26-27 slides, but some slides which are more important, I would like to spend more time on that, and some slides which are less important, I will just cover them, and because all this material is available. Friends, before I start, I just want to give in perspective that it was initially mentioned by Vikas ji also and by Shikumar ji also, that currently NBFCs are classified into systematically important, that is more than 500 crores of net assets and less than 500 crores. Also, they are classified into deposit and non-deposit taking. And further, we were also informed by the morning speaker, the first speaker, that they have further classification into 12 categories based on the activity or based on the nature of the NBFC that carries out. So currently, just to bring into perspective, what is the gambit or what is the sector of NBFC right now in India? Currently, what I have got from the supervisory returns of RBI is that the asset size of NBFCs in India today is approximately 23 or maybe more than 32 lakh crores. And if you see on the right hand side, the table shows that more than 81% or almost 81% of these assets are controlled only by 316 NBFCs. So less than 3% of the NBFCs are actually having 81% of the assets under management today. And on the opposite side, and these are NBFCs which are non-deposit taking but systematically important. So they are not accepting deposits from public, but they are more than 500 crores. And exactly opposite, 9,130 out of 9,495. So approximately 96% of the NBFCs have only less than 5% of the assets under management. So therefore, this is the broad structure we have. And this proposed changes, this proposed guidelines that the RBI has come out with actually has changed the way it looks at regulating NBFCs. The focus has shifted from qualitative aspects, it has gone more into quantitative, more from quantitative aspects, it has gone to qualitative aspects. And we'll be seeing in the coming slide how they are, how they want to regulate these particular aspects. This is the roadmap. What happened in October 21, the final scale-based regulation was formed by or was circulated, or rather it was published by the RBI after years of public comment, etc., etc. And it's been almost 11 months since that, and now this scale-based regulation has become applicable to all NBFCs, and this is going to be like the Bible for regulation of all NBFCs, which come into effect from 1st of October 2022. Immediately after that, as I was telling you, in November 21, the RBI came out with prudential norms on IRAC norms pertaining to advances on classification of advances, and this covered the automation part of it. So I will be having a couple of slides also on this. Immediately after this, this would because of implementation of 12th November circular, it is possible that the NPAs would go up because that had certain amount of changes in IRAC classification. Because of that, prompt corrective action guidelines was issued by NBFC, and this is applicable for specific NBFCs only. And for the first time, we have heard that prompt corrective action guidelines exist for banks, but for NBFCs, for the first time, it has been brought. So friends, I just want to say that all these series of changes, series of guidelines that have changed are taking the regulation or taking the supervision of NBFCs akin to banks. It's moving into that direction. They are strengthening, the regulation process, because we all know that NBFCs are important. It's, nowhere, the importance of this particular sector can be denied. Their contribution to the economic growth, their contribution to the national GDP, etc., is well known. We know that some NBFCs definitely compete tooth and nail with the banks, but their role is more, complementary rather than, competing. And we all know that some NBFCs really have grown up. The environment is dynamic, and also unfortunate to say, but a couple of NBFCs also have failed. And I don't want to name instances, but we all know that what have happened to a couple of NBFCs. So all these reasons factored together, all these reasons put together, was a wake-up call for all of us as professionals and regulators. And these series of changes have been has been brought about. Then in February 22, implementation of core financial services. So for just like we have a core banking solution for banks, a core banking solution for NBFCs having more than 10 branches have been proposed. Also, earlier some regulations which were absent for NBFCs, for example, having a chief compliance officer, etc., also have come by the April 22 guidelines. Then also large exposure framework, which was only heard of in banks, have been now brought out for upper layer, and so that I'll be taking you through that. Then certain amount of guidelines on the formation of the board, the formation of the management, and compensation to be paid to KMPs and senior management. Those guidelines have come. Then certain amount of restrictions of loans and certain amount of restrictions to loans and advances to directors, related parties, or entities under control, the common control, etc., have been come out. And then lastly, in June, the provisioning norms have been changed. And so far there was provisioning on standard assets of some NBFCs, but now there is standard assets provisioning on NBFCs like banks have also come into place. So friends, this is just a summary of what was mentioned. Now, coming to the full framework of this scale-based regulation. Just as the name suggests, it's a scale-based regulation. So what the RBI actually has done is that it has actually tried to, categorize NBFCs into these four major categories or four major layers. And according to RBI, initially, as I told you, first the supervision was based on systematically important and non-systematically important, deposit taking, non-deposit taking, and activity based. Now the full the horizon or the scope has shifted, that supervision now should be based on the size of the NBFC activity and the perceived riskiness of the particular business that an NBFC is carrying out. So based on these three broad parameters, and as per the SBR framework, the NBFCs would be classified into these four broad layers. And the first layer, which I would like to start off with, from the base layer, because those are the least, risky business perceived. So therefore, for the base layer, all NBFCs which are below the size of 1,000 crores are to be classified as base layer, and particularly NBFCs undertaking activities of peer-to-peer lending and account aggregator and non-operating finance holding companies, and NBFCs which are not availing any public funds or having any public interface are to be classified as base layer. NBFCs. The second layer is the middle layer, where mainly or probably most of the NBFCs would lie. For the middle layer, all deposit taking NBFCs, irrespective of their asset size, would be covered in this particular layer. And for non-deposit taking NBFCs, asset size of over 1,000 crores are to be proposed to be classified under the middle layer. And from the activity wise, any NBFCs carrying out standalone primary dealer or activity of infrastructure debt fund or core investment company or all housing finance companies and all infrastructure finance companies are going to be classified as middle layer. So friends, if you see the main classification here, from 500 crores, they have shifted it to 1,000 crores. And now the classification will be on, 1,000 crores. And also, if you go to see, they have, uniform about consistency in this classification, also with the guidelines for the appointment of auditors, where also NBFCs are classified below and above 1,000 crores also is done in that way. And friends, after that comes the upper layer. According to the RBI, in the upper layer, the top 10 NBFCs, irrespective of what activities they do, that are to be classified as in the upper layer. And over and above that, based on some criteria or based on some set of parameters and also some scoring, which the guidelines, which the scoring pattern is there in the guidelines, will be classified as the upper layer NBFCs. So therefore, right now, all the top 10 NBFCs based on asset size automatically are classified as upper layer, and any other NBFC based on the criteria set out by RBI will monitor that and will inform to the particular NBFC to bring it to the upper layer. So therefore, the aim of this regulation is to monitor or to regulate the upper layer of NBFCs, just like banks, more stricter supervision. Right now, what leads is then with the top layer. So right now, the intention is not to fill this layer, and predominantly this layer will remain empty unless and until RBI identifies some increase in the systematic risk and shift any of the upper layer NBFCs to the top layer. So this is what the classification talks about. Then after that, besides this, then also classification also would be mean on the basic activity that has been carried out by the particular NBFC. So based on the categorization of NBFC will be done on the specific activity that it carries on. So therefore, it also says that all NBFCs which are predominantly doing activity of account aggregator or P2P lending or non-operative finance holding company will always remain in base layer. Also, NBFCs which do not have, do not take any public funds and do not have any customer interface like investment companies, etc., would be classified under base layer. Right now, also all government-owned companies, though the NBFC says that, though the framework says that government companies, depending upon the size of these assets, could be classified as middle layer and base layer. But right now, specifically because it requires, the government companies requires some, losing some weight, trimming up, coming to speed with the regulations. Therefore, right now, no NBFC will be classified under the middle layer, but will remain under the base layer only. Then primary dealers and infrastructure debt funding companies always will remain in the middle layer, irrespective of the asset size. Then in the what could be in the middle and upper layer, depending upon the asset size, could be the CICs and housing finance companies, IFC, and the deposit taking NBFCs. And in any layer, the MFIs, the ICCs, mortgage guarantee companies, factoring companies could be in any layer. Now, the broad framework. What is the, what are the areas that this framework touches? This particular, framework touches capital requirement. Initially, CRAR the net own funds, leverage. So these, these are the areas where this framework touches. Also, this framework, requires certain amount of changes in the governance structure. Having risk management committees. It also lays down certain amount of experience and qualifications of the board, adopting of core banking solutions, CCOs, that is the chief compliance officers, KMP compensation, etc., etc. Prudential norms also, it requires prudential classification to be real time rather than currently what NBFCs are doing either at the end of the month or at the end of the quarter, etc. So this would be required at the day end process on the real time basis. It also requires certain amount of changes in the concentration of the credit and investment exposure. It also, gives guidelines on specific sensitive sector exposure like real estate or capital markets, etc., etc. Then it also restricts or regulates loans given to directors, relatives, senior officers, entities in which directors are interested, and real estate companies, etc. It also brings about large exposure framework concept also, which was not there. So this large exposure invest framework would involve not only the loan exposure, but also the investment exposure also. And then internal exposure limits also. Then most important is also this particular framework requires the NBFC, all NBFCs to have more particularly, the middle level and the upper level NBFCs to have an internal capital adequacy assessment procedure or a process, ICAP, which is called, to have it in place. And this has to be in place by 1st of October 2022, which actually will help the RBI and the NBFC to talk together, and it will help RBI supervise the NBFC in a more effective way. It also talks about disclosures changes that are required, and also for the first time divergence list which are there. So far we've heard about the divergence list in banks. For the first time in NBFC, divergence list disclosure is come. For some particular type of NBFC, it has made it, mandatory that after a couple of years or after a few years of transition, it has made listing of those NBFCs compulsory, and then other such compliances and regulations. Friends, this particular slide is a snapshot of the regulatory changes or the changes that this framework requires. So initially, yes, there was or rather a minimum level of there is a limit of net own funds for a particular type of NBFC. But now this particular regulation requires changes wherein gradually over a period of time up till March 27, specifically for NBFCs carrying out MFIs and factoring business gradually need to increase their net own funds from 2 crores to 5 crores to 10 crores. So just now varies are there, but ultimately by 31st March, they will have to bring it up to 27 crores. So therefore that requirement is there. Then the requirement for KMP is not there for the base level NBFCs, but for the middle level and upper level, there are requirements for KMPs where there are restrictions on, holding the number of offices or holding any office in any other NBFC other than the base level NBFCs. On the NPA classification, though it might not have an impact on the middle and upper layer because they have, moved or harmonized to a 90-day concept. But however, yet there are certain amount of non-systematically important NBFCs wherein yet there are NPA which are classified after 150 days, 180 days. So gradually by March 26, they will have to harmonize their their policies and start recognizing NPAs after 90 days. Then on the tier 1 capital, though in the middle layer and the base layer, there's no requirement for having a minimum capital adequacy. But as far as upper layer is concerned, there is a 9% capital adequacy for RWA. Then as the for upper layer, it is mandatory to have a chief compliance officer. Core banking solution, as I told you, if the NBFC is having more than 10 branches, then within the period of 3 years, they'll have to automate the system. And even for upper layer, they've been given 3 years to go. to have a listing. So friends, as I told you, to go in for listing, then friends, the full framework, as I told you, as more akin to bank, the focus has shifted from quantitative to qualitative. So as I told you again, the monitoring it would be based on your size, activity, and the risk exposure. Also, as I highlighted, that this particular framework gives certain exemption to government companies to be classified in the higher category. So just now government-owned NBFCs would remain in the lower level in spite of being having almost like 50% credit exposure by NBFC. Then it also very tight regulated environment will be there, more accountability, which will lead to transparency. And therefore, if these are implemented in true spirits, definitely the trust of the stakeholders will increase. Then, no doubt, it will be a big effort on account of the NBFCs to actually comply with these framework. But friends, also it would have a lot of challenges for NBFC. But also I look at it that this will be a opportunity for professional like us to have to grab this opportunity and help our clients to implement this, or advise them on, even if they are not our audit clients, to advise them on implementation of this framework. So therefore, friends, I think so the basic underlying what do you say, the basic underlying or rather I could say large NBFCs, which they had an arbitrage opportunity, arbitrage advantage, that they were not or they were restricted regulations, and they were not as strictly monitored as banks, that have gone away now. Because of all these regulations, there will not be much of arbitration available for large NBFCs to escape these provisioning, escape these regulations. So right now, what has been given over here are the existing framework, but moving forward, as I told you, 90-day norm is coming across NBFC in a phased manner, and for the upper layer and the top layer, it is already there 90 days period. Then would like to spend a couple of minutes on this 12th November circular, which I told you, RBI circular, which talked about automation, and it talked about the NPA classification has to happen as a day-end process on a real-time basis. Also, because he had mentioned that there would be change in the loan agreements which would be required. Yes, the loan agreements would have to be amended by giving examples of the date of NPA, etc., etc. But besides that, implementation challenges would be there to actually classify, identify NPAs on a daily basis. And as was mentioned, that it has to be automated and no manual intervention or manual intervention is allowed, or this has to be as a day-end process by the CBS or the loan management system itself. That would be one challenge. Second, more important challenge also is on the upgradation, because this circular brings about upgrade. So far, NBFCs were upgrading but just by collecting the minimum amount due and trying to bring the DPD or trying to bring the overdue less than 90 days. But now here, just like bank, this circular now requires all NBFCs to upgrade the account only if the entire arrears are collected on entire arrears, and not only on the critical or small amount. So therefore, this would lead to challenges. The friends, on this, there was another circular which came up where it says that time has been given up till 30th September to put the necessary system in place. So currently in the industry, certain NBFCs are taking a call or taking an interpretation that, okay, this particular upgradation full itself is postponed till 30th September. But in one reading could be that it is the requirement. If you read the, the particular requirement of the circular, it only gives an extension to put a system to implement this in place, and not, to implement actually upgradation. So that is a challenge that we will have to face moving forward. Then currently the existing provisions are there on provision of standard assets, but for the upper layer, the provisioning on standard assets have moved into the bucket just like banks, and this have to be taken care of. There is no change in the existing standard assets provisioning as far as housing finance companies are concerned. But moving forward, all these additional provisional requirements which are there because of this prudential norms will have to be compared with the ECL provision that the companies are doing as far as India system. I mean, India's companies are following. If the NBFCs are not on India's, then that's fine. But those NBFCs which have adopted India's, they will have to compute the provisioning on the regulatory basis and the ECL provisioning and compare that and give necessary adjustments if any. Then, friends, the new regulation also requires for the first time to have disclosures of divergence. Now, friends, for divergence, for some people who might not be aware, divergence are, those, divergence which come when there is an RBI inspection on the NBFC and there is a difference either in short recognition of NPA or not adequate provisioning, or the provisioning is short. And as per what regulated NBFC has done and the RBI inspection, when these are there, there is a disconnect or there's a divergence between both of this, then it's called divergence. And then this regulation also mentioned that if there is a diversion wherein additional provisioning of 5% of profit before interest and impairment, profit before tax and impairment, more than 5% if it changes, then that needs to be disclosed. And if any additional gross NPA is more than 5% of the reported NPA, then that needs to be disclosed separately, just like done in bank. But anyway, the disclosure requirement for banks is slightly different because that talks about incremental and gross NPA, but in this cases it is on the reported figure of NPA. So that needs to be checked. Then these are few of the challenges which practical challenges which could come across. But I don't know how much time I have. Can I just estimate how much time I have so I can space my the remaining of my presentation?
So we have to wrap up because Sandeep sir is also waiting.
Fine.
So we will take another 5 to 7 minutes and then wrap up.
Fine. So what I would do is now straightway, I'll try to wrap it up in the next 3 to 5 minutes and just cover the important slides. And yes, this is the requirement for having a CET capital just as there in banks. But what this regulation has given is, for upper layer of NBFCs, 9% of RWA is to be maintained as CIT. And this regulations which have come out gives detailing, guidance is given wherein, wherein the UCB, they have explained each item, what is to be considered under for calculating of the CET is given. So you can go to the RBI guidance. Only thing over here we have to keep in mind is that this is one of the criteria that if you breach the CIT 1 level, then prompt corrective action can be triggered. So this is what you have to keep in mind. Tier 2 so far has not come. Tier 2, the RBI has not come up with any clarification on that. On this particular thing, yes, as I told you that the NBFC internally needs to do an assessment. It needs to have a document in place. It needs to have a policy in place, which will help in supervisory by the RBI. It should have an internal policy to assess that it has sufficient capital and, sufficient capital is there. Or the need of the capital to meet its future risks or future growth of the NBFC. So that's a full policy document that they will have to create. And this full document will have to, actually have covering all these aspects, a board approved policy which will have to be placed. Actually, that is the requirement to be done by, after 1st of October. The objective of this particular document full will be to ensure, that the adequate capital is there to support all the risk management techniques for monitoring and, mitigating the risk that is possible in the NBFC. Then, as I told you, board approved policy for large exposure framework also is required by these regulations. And the large exposure framework, not only as far as the loans, but also as far as investments, the large exposure to all counterparties or group of counterparties, that is also defined in this particular framework, and that will have to be abide with. Friends, this is the slide which snips out the full new disclosures requirement for base level, for the middle level, and for upper layer. This particular slide is self-explanatory. The full disclosure, the new disclosures with this RBI regulation are based on intergroup exposure, unhedged foreign currency, the corporate governance, which has become important, breach of covenants on loans or debt, etc., etc. That will have to be discussed. Divergence in NPA, which was discussed, and all the upper layer NBFC, even though they are not listed and they have got time, all disclosures which are relevant for companies under the SEBI LODR obligation. So those will have to be disclosed for the upper layer categories of NBFCs. As I told you, more detailed disclosures will be required, and all are actually detailed here in the presentation. And this presentation I will share it with the institute, and you can take it right now. What disclosures are made are only disclosures as per Schedule 3, as per applicable GAAP, either Ind AS or the accounting standard, and the RBI regulated. Beyond that, no other disclosures are made by NBFCs. But now a lot of disclosures will be required because of this regulation. Related party disclosures, one important thing is that the definition of related parties has been changed to include trust and other bodies. It was always there under Ind AS, but under IGAP it was not there. So to bring in other trusts and other bodies where the directors have control, that is to be included in the related party disclosure. So that has been that has been changed. And corporate governance, again, the guidelines are pretty much clear on the constitution of the board, on the qualifications of the board that are required, etc., on the restrictions of KMPs to take up positions elsewhere, what executive directors, where they can hold office, where they cannot hold office, role of independent directors, etc., Transition provision of 2 years have been given to, keep or to comply with these provisions. And again, corporate governance, this is just an extension of that. And I think so I would have to wrap it up very quickly. So I think so I'll end over here.
Thank you so much, sir, for sharing your knowledge with all of us. And it was really a great session. And now I would like to invite our third speaker, C.A. Sandeep Welling, who is a practicing chartered accountant having more than 30 years of experience. He contributed in the institute as a member of AASB and expert advisory board of the ICI, and also contributed to several professional publications on BFSI and audit quality standards. Today, he will share his expertise on IT security risk in audit of NBFCs. So, sir, I welcome you in today's session and requesting you please start with your topic, sir. Thank you so much.
Thanks, Manish, and thanks, Vikas, for a nice session. Way back when we started our career in the profession, there was a common phrase that I used to hear, that every business is a finance business, wherein input is finance, output is finance, and the activity of your choice is being done in between. Over the period, I now realize that the definition has further changed. And every finance business is predominantly an IT business. Without IT, it's impossible to further your professional causes in the finance business. And therefore, I believe that IT is becoming a backbone of the finance business. And unless during the course of our audit, we ensure that our IT teams are geared up to support us with the right perspective, we cannot say that we have done the justice to our audit. So therefore, I thank the organizers to select this topic, and I would like to introduce my colleague Bhakti on the show, wherein she will present this IT security aspect in a very detailed manner. Now, this particular session will actually go along with the IT aspects, and it would conclude on how auditors will take the notice of this during the course to ensure that our risk, our audit risk are covered. So Bhakti, I would like to share the presentation.
Okay. Thank you, sir. So it is visible to everyone?
Yeah.
Okay. Yeah, good afternoon, everyone. So today's topic is IT security risk in statutory audit. So as you all are aware that in last 2 to 3 decades, technology has actually encompassed our entire life. And since last 2 to 3 years from COVID, that organization has actually transformed their entire IT operations into into cloud. So it's like a organization induced digitization. So its focus is shifted from the it's more of a forced digitization. Then various new tools have been implemented, so that all the neo banking and various fintech companies are actually introducing various tools which are available on a cloud. So they have actually forced to migrate some of the activities on a cloud, so the cloud adoption is also faster. And earlier that digital department or the IT department were considered as a separate department, and they were not involved in a decision making process. But now they CISO or chief digital officer or the chief technology officers have become the integral part of entire business, and they are also a part of a business deciding business strategy, because they are the people who actually implement entire the business strategy. As per the recent RBI reports, we have observed that actually 60% of the loans are booked through the online app. And RBI has also introduced various initiatives to increase digital payment. And various organizations like NBFCs also implemented various tools which actually in their entire loan life cycle, which helps them in taking the credit decision faster. So I just explained these 2-3 areas where actually more digitization has happened. First is that the in-depth customer profiling. So as the data is available everywhere on a social media and from various apps which we downloaded from Play stores. So the data is available, and which helps the NBFCs or the fintech companies to analyze the customer profile and customer behavior and how that customer will behave in a future. So that on that basis, they actually identify the target audience or the target customers, and which helps NBFC companies in the second phase where they're targeting the right audience. So they are once that customer profile is done and customers have been identified, then they perform the target marketing or the target advertisement to that particular set of customers in customer acquisition process. And once that acquisition happens, then the third part is at the easy calibration. So that is basically the credit underwriting part, where we have already that company is already aware about the customer behavior, their pattern of behavior, their credit history, and on that basis the credit decision is very faster, and it does not involve the manual intervention. So it's all through the artificial intelligence, which gives a effective and efficient result. And all these processes actually helps organization to enhance their business proficiency. So whatever I explain is from the customer side, or the customer acquisition point, but there are internal processes as we have like that is a basically loan maintenance and the other process. So organizations have also started implementing various bot and various routine activities are to be automated, so that becomes a robotic process automation which helps them in avoiding the routine activities and also saving the cost on manpower. So these entire various areas in organization or the NBFCs is typically the digitized or is automized. So when we are doing audits, that we have to consider all these aspects. Okay. So one part I have explained that how the companies have been adopted the digitization. Second is that the RBI is also pushing. RBI is very positive in digitization, and they are introducing various guidelines and various initiatives to promote the digitization. So like a digital lending or the P2P lending. Second is that the Aadhaar eKYC for customer onboarding. This is not related to NBFC, but establishment of a digital banking department that's for the commercial bank, but it will also come in a NBFCs sooner or later. So NBFCs are adopting the digitization, so that part will also be applicable. Then for the digital payments also, they have launched 3 new payment initiatives, and to address the customer grievances or the customer complaints related to digital payments, they launched the Digi Sathis. So why I have explained the thing, one is that the corporates are adopting the digitization. Second level is that the regulator is very positive in a digitization. So how as an auditor we are doing? So what is our role? Are we understanding everything, and are we adjusting our audit techniques and methodology as per their change and as per the change environment? So here we have to see how we are doing or how we should do the digital audits, or how we should understand the digital footprints and perform the audit accordingly. So I try to set the linkage between our traditional approach with our with cloud environment, or how we have to perform in this digital environment. So as you all are aware that the ICFR or the IFC is the approach we normally use for the ITGC testing. So here I explain the things like first we have to do the trial balance, we have to take. So on the basis of the trial balance, we have to identify and map the business processes with each GL. And for once we identify the business processes under our scope, then we have to see what IT applications are involved in that each business process. So these up till this now we have been using in similar way. So it is not a new thing for us. But after that, so once we identify the IT application, earlier that application was on premises or was on customer's place only. Now the applications are on a cloud. So we have to change our methodology. So I just bifurcated the thing on the on-premises and then the cloud environment. And as we also perform the audit, so many times it so happen that customer says that we have migrated to cloud, and Azure is there, and then the AWS. So they are taking care of everything. So here actually we can mislead. So we have to understand what that application is, how that application is managed, who is managing that application. So entire responsibility of that application we have to understand, and accordingly our audit processes are to be set. So there are three models are there which actually cloud service providers are provided. So I just given in this picture. So first I explain which is on-premises, which is our previous method of doing the audit, where everything is on the managed by the customer only, and we have to deal with the customer IT department. And the next 3 are related to the cloud. So one is the infrastructure as a service, platform as a service, and third is the software as a service. So blue one which I depicted, that is basically managed by customer, and the red one is managed by the cloud service provider. So we have to see the audit control testing accordingly. So blue one where we actually whatever the audit control testing we have to perform, that we have to go to the company, and the red one we have to take some assurance from the cloud service provider. So in case of an infrastructure as a service, if we see that the application and the data level thing are managed by are managed by companies. So in that case, actually, whatever the audit practice we used to follow in previously, the same practice we have to follow over here, because company has a complete control over this application, because company is only developing, and access level change, any changes are happening in the applications, or the any data migration, or any data encryption level control. So everything, or database level control, everything is under the control of company. So the same practice or the same methodology we have to follow in this infrastructure as a service model. And for the infrastructure level, like a servers and the network level, that we have to take a comfort from the cloud service provider. In second case, platform as a service, where actually basically the it's more of related to the software development companies, but here wherever the applications are developed, it's typically managed by a company only. So again, here also some part of application and data level controls are to be handled by a company, and we have to perform the similar procedures. And in case of an infrastructure, the ITGC level testing, which typically considers as a patch management, and then the antivirus or the backup, these are to be considered, or the performance level issues. So these are to be handled by cloud service provider. And the last one is that a software as a service, where entire thing is managed by vendor, and where company does not have a control over this infrastructure. And that is why whatever you want to perform any audit, or any obtain any assurance from application level or the data level, that is to be obtained from the service provider only. So here actually the same thing I depicted over here, on premises, then company, and then the cloud. So what kind of testing are to be performed? So application level testing, where is to be performed, then integration level testing. And in the case of a software as a service, where as I mentioned, entire thing is managed by cloud service provider. So we can obtain as a SOC 1 or SOC 2 report, or in an Indian context is SA 402, we can take a comfort from them. And as well as a SAE 3402 a report we have to obtain, and which actually that allow, as you all are aware, that reports are very exhaustive one, and controlled design level testing also it's mentioned, and the effectiveness level testing is also, results are also mentioned, so which gives us a comfort. And in our reporting level also, we can mention that for these particular controls, or we are relying on the SOC 1 report or SOC 2 report, or these reports, and through that we actually get the comfort for our signing purpose. Okay, the last slide is that this is basically RBI Information Technology Framework, which issued in 2017. So now we are in 2022, so almost 5 years have actually gone. So all NBFC companies must have implemented all these frameworks. So I just list down the basically the sections which actually, or the requirements which has impact, or which may have impact on our financial reporting, and we have to consider while performing the audits. These are the things like a segregation of functions, and then role-based access are given. Then maker checker for each transaction has to be there. So for each accounting system, whether maker checker system is there or not. Then audit trail they are saying, as this is also company law requirement also. So for each IT asset, like it's maybe for the end user computing system, or maybe at a server level, or at the application level, because they are using the word IT assets and not the IT application. So for each level, we have to see whether audit trail is mentioned, is there or not. And if it is not there, then it does not give a comfort whether any modification or any data tampering has happened, then we don't have comfort to that. Then digital signature also RBI is suggesting for important documents, and the high value fund transfer. Then IT enabled managed information system. So RBI has given a few reports Some reports are related to the IT infrastructure level or the performance, IT infrastructure or the IT server level performance level report. But some of the reports are like a NPA, then treasury reports, various are the loan ticket size reports or the classification of various customers among the IRAC categories. So these reports are also RBI is suggesting we need the NBFC should have. So it's a 5 years. So company must be having or these reports. So we have to see whether these reports. We have to see the IT controls around these reports, whether these reports have modified during the year, any logic is changed in that. So we have to see the version control of these reports of last year report and the current year report, and see what changes they have made and whether that reports or that changes have an impact on our reporting purpose. And if new report is introduced, then we have to see whether that entire change management process, like a BRD is raised or something change approvals are there, UAT testing is performed. So all these controls we have to see if new report is introduced during the financial year. So from IT report perspective, earlier we used to perform the IPE testing, which is information provided by entities. The same level testing is to be performed for these things. RBI also suggested that the regulatory and supervisory return should be system driven. So from that also we have to see whether it is completely system driven or not, or whether any manual interventions are there. And if it is a manual intervention is still there, then what is the if data is modified or chances of a modification, and how it is impacting our reporting purpose. So that we have to evaluate. Last one is that the IS audit. IS audit in RBI guideline, they have given an elaborate scope for what is to be performed in an IS audit, and they also mentioned that this audit is to be performed before the stat audit. So when we start this audit, we have to obtain these reports, and these reports actually observations in that report help us in assessing our materiality aspect or assessing our deciding our audit techniques also. So any
even for SA 315 risk assessment, this is very useful.
Right. So they are saying that the various reports are so we have to see whether that IS audit report is typically only ITGC or the IT infrastructure level audit report, or whether it is also application level report. So ideally they have to perform the application level IT controls testing also, which help us in our identifying the inbuilt control in the system and gives us a comfort. So that is the first part. Then second part is the third party arrangements. As I entire thing is that the thing is digitization and the cloud or various IT systems have been used. So we have in-house IT department is not competent to actually develop and implement such things. So normally they are dependent on outsourced vendors. So we have to see in our scope or in our applications which are the things that will be managed by vendors and what are the controls the vendor is exercising, because the data is also shared with the vendor. So privacy aspects we have to also see. And then from how they are accessing the systems, how they are accessing our data, whether any changes have been made, what are the controls or any log monitoring things are there. So that we have entire controls we have to see. And third-party vendor audits have to be also performed. So if that reports are available, that also gives us understanding the controls are available over the vendor location. So that is also our the factors which help us. Another one is that the vulnerability management. As I mentioned, like various applications and entire business process is automized. So wherever automizations happens, RPAs are built, or any chatbot or the bots are developed, or maybe many APIs like application programming interfaces are also defined. So for each entire ecosystem, that vulnerability assessment has to be performed, and that report has to be obtained before the audit. And I understand that reports are very too technical, but that report also contains the implications and then the risk. So we can understand what are basically the risk along with the IT team, and whether that all these observations have been closed or not, and whether that any application is whether our scoping application or for all our scoping application vulnerability assessment has been performed or not, or if it is not, then we have to raise this point to the management also. So these aspects have to be considered in vulnerability management. And the last point is that the cyber incident. We have also seen that many of the companies have actually exposed to cyber attacks during this COVID era, and because of that, actually, RBI requirement is that company has to report to RBI as well as to CERTI within a specified period of time that they are actually exposed or they have faced the cyber incidents. So you first check whether these cyber incidents have happened in this organization, and there is a defined checklist or the defined templates are also given in this framework, which actually gives a detailed description of this, whether which application is impacted, and whether it is impacted on customers, impacted on availability or the integrity part. So just see whether any incidents have happened during the year, and whether these when our application which has a financial impact is exposed to such cyber attacks, and what kind of a breach happens, and then obtain entire detailed report and how it is impacting our reporting purpose. So that we have to actually see in a detail. So that is said done from my side.
So basically, one of the eligibility of a statutory auditor, if we were to really look at, is also whether we have sufficient team members with us who understand these IT security aspects and the threats involved with it. Number two, Bhakti briefly touched upon one aspect, and that is this NBFCs collect lot of data, customer data, various people data, and the Data Privacy Act, which is about to come into force, will have a huge ramification on existence or penalties or existence of the organization if that is breached in any way. So these are certain things which are we as an auditor cannot escape, and therefore it is necessary that some technical person from our team member has to ensure that these comforts are given to the concerned partner who signs it. So this is the broad way we should be moving ahead on the IT side. The topic is quite huge, and half an hour is not sufficient. So this was more of a cursory glance towards what is the requirement. So over to you. Thanks.
Thank you.
I know there was time constraint, but definitely the session was very knowledgeable. And thank you so much for enlightening our viewers. And also, because we have a shortage of time, there are a lot of questions that we've received from the viewers, but we'll be taking a few questions. And now I would request all the panelists to answer the questions as per their expertise. Okay. So we'll be taking the questions. The first question is that certain NBFC advertise overdraft facility being offered. How is that possible when NBFCs are typically not expected to have operating accounts? Sir.
Sorry, I could not hear. If you can please repeat it again.
I'll repeat. I hope Manish sir is also there. I'll repeat the question. Certain NBFCs advertise overdraft facilities being offered. How is that possible when NBFCs are typically not expected to have operating accounts?
To be very frank, I'm not very sure. Why there will be no operating account? There has to be operating account. So I really am not really clear on the question. Manish, if you want to add something.
No, same here. Even I can't understand, because there are certain amount of NBFCs which are giving these type of facilities.
Right.
So-
The next is, what all procedures do we do to ensure the genuine borrowers?
Okay, that's a very, very lengthy topic, to be very frank. That's not a question to be answered in a minute. That will be a topic in itself. Because as I was talking in my presentation also, as an auditor, one of the important thing for us to find, is there any ghost borrower? Because there have been frauds in past wherein the NBFC has disbursed amount to XYZ and those XYZ were not existing at all. Right. So that's definitely a very important element. Key thing in that will be that how are the systems and processes which are in place in the company? How are their internal control systems working in that regard? How is the internal audit system working in that regard? Because a statutory auditor will have limited role, because we at the best can do some of the test check. So it will be very difficult for the statutory auditor to really find out. So suppose I am auditing a company which are having 30,000 accounts. I can at best go for 50 accounts or 100 accounts or at max 200 accounts and check whether those files are completed or not, whether the documentations are there or not, whether the KYC things are there or not. We can do all that, and that we must do. That much I would like to emphasize, though we can't do the entire thing. But a good sampling, which I have said in my presentation also, a good check end to end with respect to those sampling customers without having any compromise to check anything. So full check on those customers which you have selected, ensuring everything is in place. And if something is missing, then to go a little more deeper into it. So that is something which we can do. We can also do some of the test check calls, that whatever samples you have selected, apart from going through the documentation, we can also make calls to them to find out that yes, those are the actual people whose details are being given. So all those steps we must do and document with us. And that, I believe, is the best as a statutory auditor what we can do.
Yeah, there is also a move towards having a common digital platform for a KYC, which is being debated at the moment. Once that happens, that could be probably the information would be available to the respective NBFCs or banks. So which auditor can, on a sample basis, verify.
And just to add also that you will go through the internal audit reports also and your own IFC testing also. So because that's ultimate responsibility of the bank. Statutory auditor's role would be only a selected sample.
Okay, thank you, sir. In case of NBFC non-deposit, can such companies take the unsecured loan from other than directors and shareholders?
If they are non-deposit accepting taking, then they cannot.
Okay. And when a registration is rejected by RBI, it is advised by the RBI to wind up the company. What is the other way to deal with such situation?
Vikas ji, आपके पास कुछ ऐसा practical आया? I mean, I have not come across such a practical actually. I mean, this thing. But other than besides going to the RBI and again speaking, and if the RBI has given and you need to wind up, then it has to do the winding up.
I don't think we have any choice to suggest any alternative as
no
against
other
regulator.
into it.
Okay. Okay. What is meant by the customer interface in the base layer?
Customer interface in the base layer would mean that you don't have any interaction or any customer. Say, for example, now an NBFC is an investment company. So therefore, it manages own investments. So therefore, there will have been no customer interface, means giving loan or accepting deposits. It will just be their own activity. When there is no speaking to customer, there is no interaction with customer, and there is no borrowing from customers also, or no public borrowing.
Right, sir. Oh, we'll wind up here then, and we have a lot of more questions from the viewers. We'll definitely share a list with you all so that you can provide us the answers for them. And on behalf of PDC, I'm really grateful that you all spared the time for us and shared your expertise, knowledge with our viewers. And I'm very sure that all the viewers were enriched with the knowledgeable sessions. And we thank you for such a great webinar. Thank you so much, sir.
Thank you.
Thank you, everyone.
Thank you.
Thanks, ICI. Thanks, Sandeep.
Thank
Thanks,
you.
everyone. Thanks, all the viewers. Bye-bye.
Thank you so much.
Recordings.